Most beginners think index fund and ETF are opposites. They're not. And if you don't understand the difference, you might be choosing the wrong structure without even realizing it. Here's the simple truth. An index fund is about what you invest in. An ETF is about how you buy it. By the end of this video, you'll know exactly what each one is, how they work under the hood, and which one makes more sense for a beginner investor. First, let's go over some definitions. An index fund is a fund that tracks an index. That's it. Examples of these are the S&P 500 and the FTSE 100. Instead of trying to beat the market, it simply mirrors it. No stock picking, no predictions, just matching the market. Now here's the part that confuses people. An index fund can exist in two different wrappers. It can be a mutual fund, or it can be an ETF. So ETF is not the opposite of an index fund. Active management would be the true opposite of index investing. ETF is just a container. That one distinction already removes most of the confusion beginners have. Now let's talk about what actually makes ETFs and index mutual funds different, because there are real differences and they matter in specific situations. First, how you buy and sell them. If you buy an ETF, you buy it like a stock. It trades all day while the market is open. The price moves throughout the day. You'll see a bid price and an ask price. You can use limit orders. You can buy instantly. You can sell instantly. But an index mutual fund works differently. You place your order during the day, but it doesn't execute immediately. It executes once per day at the closing net asset value, the NAV. That means everyone buying or selling that day gets the same end of day price. So here's the key question. If you're investing for 20 or 30 years, do you actually need intraday trading? For most beginners, no, but that structural difference is real. Second difference, pricing mechanics and spreads. Because ETFs trade like stocks, they have something called a bid-ask spread. The bid is what buyers are willing to pay. The ask is what sellers want. The difference between those two numbers is the spread. That spread is a small cost you pay when you trade. With index mutual funds, there is no spread. You transact directly at NAV. Now, for big popular ETFs tracking major indexes, spreads are usually tiny. But they exist, so if you're constantly buying and selling, spreads can add up. If you're investing monthly and holding long term, the impact is usually minimal, but it's still part of the structure. Now here's the part that makes ETFs feel almost too easy, the plumbing underneath them. ETFs don't just float randomly at whatever price people feel like paying. There's a mechanism behind them called creation and redemption. Large financial institutions, known as authorized participants, can exchange ETF shares for the actual underlying basket of stocks. If the ETF price rises above the value of its holdings, institutions step in and arbitrage the difference. If it drops below the value of its holdings, they arbitrage it the other way. That mechanism keeps ETF prices very close to the value of what they actually own. You don't need to memorize the details. Just remember this. ETFs are engineered to stay aligned with the index they track. They aren't detached from reality. If this cleared up the real difference between index funds and ETFs and why the wrapper matters less than you think, hit subscribe. I drop breakdowns like this every week to help you invest smarter without the confusion. Don't miss the next one. Now let's talk about the part that actually matters most over decades. Fees. Both index mutual funds and index ETFs can have extremely low expense ratios. Sometimes they're nearly identical. Over 30 years, a small difference in fees compounds. But often the difference between an index ETF and its mutual fund equivalent is tiny. So what really matters most isn't the wrapper. It's what you own, what it costs, and whether you stay invested long enough for compounding to do its job. So what does this mean in the real world? Let's say you're investing €200 a month into a global index. You're not trading daily. You're not speculating. You just want long-term exposure to the market. If your broker offers low trading fees and easy ETF access, an index ETF works perfectly. If your platform allows automatic monthly investing into an index mutual fund at NAV, that works perfectly too. Performance over 20 or 30 years, assuming similar fees and the same index, will likely be almost identical. But there is one real-world difference that matters more than people admit: behavior. ETFs feel like stocks. They move during the day. You can watch them tick up and down. That flexibility can tempt people to trade. Index investing works best when you buy, hold, and repeat. So sometimes the structure that feels more flexible can actually encourage worse behavior. And behavior is often the biggest risk in investing. So instead of asking an ETF or index fund, ask the question that actually protects beginners. Which one makes it easiest for me to invest consistently and leave it alone? Here's a simple beginner checklist. If you're choosing between an index ETF and an index mutual fund, ask 5 questions. 1. Am I buying the same index? Because ETF doesn't tell you what you own. An S&P 500 ETF and a global ETF are completely different bets. 2. What's the total cost? Not just the expense ratio, also trading fees and the bid-ask spread if it's an ETF. If you're buying monthly and holding, fees matter more than price movements. 3. Can I automate this? If your platform lets you set a monthly buy and forget about it, that's worth a lot. The best investment strategy is the one you'll actually stick to. 4. What's the tax treatment where I live? Because in some countries, taxes can matter more than anything else. The best fund on paper can be worse after tax. 5. What's my behavior risk? If seeing an ETF price move all day will tempt you to trade, you're paying for flexibility you don't need. And that leads to 2 beginner mistakes that cost people real money. Mistake 1, turning a long-term index investment into a short-term trade, checking it daily, panicking on red days, selling and buying back. Index investing works when you let compounding do the heavy lifting. Mistake 2, chasing the wrong kind of ETF. A broad index ETF is simple, but the ETF world is full of niche products, leveraged ETFs, single sector ETFs, thematic hype ETFs. Those aren't bad, but they're not beginner tools. Beginners should usually start broad, cheap, and boring. If you get those 2 things right, automate and stay broad, ETF versus mutual fund becomes a small detail. So here's the clean summary. An index fund describes the strategy, tracking a market index. An ETF describes the structure, how that strategy is bought and sold. They're not opposites. They're not competing ideas. In many cases, they're the exact same investment in different wrappers. If you're investing for the long term, the bigger decision isn't ETF versus mutual fund. It's whether you're investing consistently, keeping fees low, staying diversified, and avoiding emotional trading. That's what builds wealth. Remember, the biggest edge isn't picking ETF versus mutual fund. It's staying invested consistently with low costs and no emotional trades. If you want more practical clarity on modern money and markets, subscribe now so you never miss a breakdown. See you in the next one.